Assalamu alaikum friends, welcome to Test Understanding 7 from your SBR textbook, SBR Kaplan textbook, the last chapter question and answer. And this is one before the last. After this we have Test Understanding 8, that's the last. Before I finish all the questions from your SBR textbook, right? After that I'll be just focusing on SBR revision kit, 2 questions per day. Okay, so I think I need around 10 days to finish all the questions in your revision kit for the December exam. So this test your understanding 7 is so important. All the major standard is covered in this question. One single question. Whether it is your IFRS 8, that is your operating segment, which is never asked before. I mean, in all the previous question, it was not asked. Then we have your IFRS 5. Then we have your IFRS 9. Then we have your IFRS 15, your revenue. So all this is covered in this. All the major, the big topics, big chunk of your syllabus is covered in this. So make sure that you watch this till the end to have a clear understanding of the standard and how to apply it in a question, right? This is like a demo for you. So Bath is a public limited company with a reporting date 30th September 2004. Financial statements are prepared accordance with international financial reporting standards. All these are repetitive. Okay, they will be having some issue that you have to solve. First one is relating to, they have identified some operating segment. Okay, they have given you. Now requirement is similar like the previous one, correct accounting treatment. Okay, for 25 marks 4 events are there, so I'm not going to waste so much of time. uh, let's read the first one and finish it off. Segments all earn different gross profit margins, and accordingly Bath has concluded that they exhibit different economic characteristics. First one is different gross profit margin and different economic characteristics also, all the operating segment, right? Now Bath requires advice on how these segments are reportable in its operating segment disclosure note. Okay, so for this purpose you can ignore A, B, C and D. How many you have? Let's see. 1 2 3 4 5 6. Let's see how. This is purely knowledge. Okay, you have to calculate, so it's not going to be hard. It's very straightforward. Split standard IFRS 8, right? So, and remember this standard also many students don't study properly because it does not come so much in your SBR revision kit. If you see, it didn't come in the past also, maybe once or twice, does not come very frequently. So but that does not mean that you should not study this part. Every standard is important. Okay, so operating segment you have to report if these conditions are there. This is the quantitative threshold. Remember your quantitative threshold. Okay, the 10% or more of your revenue, profit and loss and asset. So it's the same thing. And when you're taking your revenue, both internal and external, has to be 10% or more of the combined revenue from all segment. Same with your profit and loss, 10% or more. And asset also 10% or more. But for profit and loss, remember, there could be some that is just having losses, some that are just having profit. Add your loss and add your profit and see which one is greater out of the two. Okay? Greater in absolute amount, whether it's your loss that is greater or your profit. So the amount that is greater. Okay? The combined reported profit. Second, the combined reported loss. C. So 10% of the greater of these two things you have to take. If the profit is greater, 10% of the profit. If the loss is greater, 10% of the loss. Out of these two, whichever is greater, you have to take it. Then there's a threshold which is 75%. What is the 75% threshold? See, the total revenue, okay, that are reported by this operating segment is less than the 75% of the entity's total revenue. Okay, IFRS 8, this standard says additional operating segment has to be identified as reportable. Even though it was not reportable before because it didn't meet the 10% threshold, but now you have to include it as operating segment. Why? To meet the 75% threshold. It's a must. Okay, this is pure knowledge. Nothing you are relating to the case. So now we are doing the calculation one by one. Okay, for revenue, for reported profit or loss, see how the calculations are done. Okay, don't be in a hurry to finish it. I will go slow. Profit and loss, or first start with revenue. Okay, so if you see the revenue, 10% of 609, which is 60.9. So all the segments with total revenue greater than, if any segment has a revenue greater than the 60.9, because 10% of the total revenue, then it has to be reported. So in this case, let's see who passed the test. Okay, 609 is already given to you, nothing to calculate, just take 10% of it. 60.9. So if you say 60.9, Delivery service, yes. Sorry, we'll mark here. Delivery service, yes. Vehicle hire, yes. Rest only these two. Delivery service and vehicle hire passed this test. That means they have to be reportable. You see, you have to write the segment also, the name of the segment which passes this test. Now we are going to the reporting profit and loss. This is a little bit different than your revenue and asset, because revenue and asset is very straightforward. Okay, and when you're taking your revenue, sometimes they might give you two types of revenue, internal as well as external. Okay, so in the total revenue section only you have to take 600, the 10% of this, not the external, or not just the internal. Okay, now, so total profit, if you see, you have to add up and see the total amount of the profit and total amount of the loss. Okay, so the total profit is 87 million. How? 62 plus 40 plus 8 plus 3. We'll see. It is 87. Just add all this, 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 and this. 4 segments are making profit. Only one segment is making loss, which is 10. So your loss is just 10. Right? Your loss is just 10 million. 10 million is the loss. Which one is greater, 10 million or 87 million? Definitely 87 million. So take the 10% of 87 million, which is 8.7 million. Okay. It could be profit, it could be loss. Anything, if it's greater than 8.7, it has to be reported. It could be loss also, not only the profit. So if you see here, 8.7, it is greater than 8.7, greater than 8.7, greater than 8.7. 3 are there. Now, removal service also came with the other two. You see here? Delivery service and vehicle hire was already there under revenue, also they are operating. But now one more is added, which is removal service. Does not matter whether profit or loss. Both has to be greater than 8.7%. Asset. Very easy. Total asset. So total asset is 496, take 10%, 49.6. So this is greater than 49.6, 49.6, 49.63. Again, removal service. The same 3 which is there in the report of profit and loss. Delivery service, vehicle hire, removal service. Okay. Now 75% test it has to be met 75% test. Okay, so based on the above 3 tests, they are reportable. Delivery service, vehicle hire, removal service, these 3 are reportable. How? When you are checking the 75% test, it has to be only the external sale. You are not taking the total sale this time. Take the external sale of these 3 which are reportable. So according to this, if we saw, what is it? Total. See, vehicle repair and road rescue. In all the 3, it is not a reportable segment, so it's out. Only first 3. So let's see, 281 plus 96 plus 46. Just take 75% of this 452 and check. So according to that, just add this 3. Only the first 3 you have to add, which is 423. Okay, so 423, just take it out of the total external revenue, which is 400. So add this 3. This will be over 452, right? Because the total external revenue. Let's see what is the percentage. It has to be more than 75%. Otherwise, you have to record more to add to make it up to 75%. So in this case, it is 93.6%, way above 75%. So no need to add more. These 3 are only will be your reportable segment. So no other segments needs to be reported. Only these 3 are reportable based on the above 3 tests, as well as the 75% test is satisfied. Now we are coming to part B. Part B is a different standard. It is about your revenue. 5 marks. So Bus Road Rescue Division was launched in the current financial year. Customers are charged an annual upfront fee if the customer's vehicle breaks down during the following 12 months. Bath will send one of its merchant mechanics out to fix or recover it. The finance director of Bath has noticed that the vast majority of road rescue customers did not require any breakdown assistance during the year, and so is proposing to recognize revenue upon receipt of the annual fee. How are they recognizing revenue? Based on the annual fee that they are receiving. Once they receive the annual fee, they recognize revenue. Now you have to see whether it's correct or not. For 5 marks. Okay, so which standard talks about it? IFRS 15. This standard is also very important standard. Okay, students often make mistakes with the standard. They start listing all the 5 ways to stages when you have to how to recognize revenue, which is not required. Okay, so when do you recognize revenue? When a performance obligation has been satisfied. How do you satisfy performance obligation? At a point in time or over a period of time? Those things you have to write. It could be over a time or at a point in time. Okay, it has to be there at the date the contract has been started. They have to tell it. Okay, so by transferring a promised good, that you have promised that you're going to transfer this good or service to the customer, you promise it, right? Then you satisfy performance obligation. It could be over a period of time or at a point in time. Okay, so if for over a period of time there are some criteria that needs to be met. At a point in time it's easy. You give a good to customer, control goes to the customer, recognize the revenue. But what over a period of time it's a little bit tricky. So entity transfers control of good or service over a time. That means they satisfy performance obligation over a time. That means they have to recognize revenue over a time if one of the following criteria is met. If any one of this is met, then it's over a period of time. You cannot say at a point in time. What are the three conditions? This is in bold, it's from the textbook only. If you forgot, go back to my FRS 15 lecture and see. Okay, the same as it is. Customer simultaneously receives and they benefit also. One example is teaching. When a teacher is teaching, okay, the teacher is delivering the lectures and the students at the same time they're getting the benefit also. It's not that after a teacher has performed her action, his or her action, then the child is getting the benefit. No. But what happens when you are giving a good to someone? Let's say I'm selling my laptop to a customer. Customer will only benefit after I have sold that laptop to the customer. That means I have performed a duty, right? I have sold or I have sold the laptop. Then all the customers receiving that benefit by using that laptop. But teaching, I am teaching and they are receiving the benefit at the same time. It's happening at the same time simultaneously. There is no delay in the receiving and getting the benefit. So, over a period of time. Second, entity performance creates or enhances an asset that the customer controls or the asset is created or enhanced. Okay. Third, performance does not create an asset with alternative use to the entity, and the entity has an enforceable right to payment for performance completed to date. For example, construction of building. For the last point, I have an example: construction of building. When you have bought a building, let's say you want to build a hospital, okay, for a customer. Okay, you have a contract to build a hospital. Now customer does not want to use a hospital, he wants to use that building for some other purpose, but already halfway the hospital has been built. Now you cannot use it for some other purpose and sell it to some other customer. You cannot do that. You have to recognize it over a period of time because you cannot use that for any other purpose. If you have to, you have to break it down and all those things, but those things are not so important. You cannot use it because it is used for a specific purpose. Alternative use is not there. Then it's over a period of time. Okay, so in this case the recovery service that they have to recover and all is consumed as time passes. So since the service for a prior month cannot be reperformed again in the future, revenue should therefore be recognized over time rather than upfront. Okay, you cannot reperform the same thing again in the future. The service. One example is service. Services most are recognized over time because services you give over time, right? So one service that you have performed prior month, you cannot perform the same again in okay. So this is the example of the second item. Second, the entities create or enhances an asset that the customer controls as the asset is created or enhanced. Okay, so every time let's say the customer is controlling an asset, okay, you're performing some service, you are enhancing the performance of that asset every time because it will not be same every time. Okay, every time you'll be enhancing it. So the entity's performance can enhance an asset that customer controls. Okay, so in this case, that's why you cannot reperform it. Every time you'll be doing different service to enhance it, but it will not, the same service will not be given again. So that's why it has to be recognized over time. So This is about recognition of revenue, right? We have to talk about that. So an output method based on the time. Remember, when it's an overtime, there are two types, two methods which you can measure. Input method, output method. Input method means your cost and everything, how much time you're taking. Output method means the result that you have achieved. So an output method based on the time that has elapsed on the contract would probably provide the best estimate of the amount of revenue to recognize. That means how much time has went by. Okay, on this contract. This will be a best estimate for you to recognize your revenue rather than receiving annual fee. It's a little bit complicated because over a time it's a little bit complicated, but over the time, when you practice more and more questions on FRS 15, you will get used to it. Now we are moving to 6, which is an standard. Okay, let's. I'm not going to tell you the standard. Maybe you have seen the answer, but anyway, let's see. Bath purchased a new office building for 20 million, and this was attributed to useful economic life of 50 years. On this date, the decision was made to sell. Which date? 30th September 2004 to X4. This was 20W4. Okay. At this date, fair value was 17 million. Cost to sell was 0.1 million. Building was immediately marketed for sell 17 and it was expected to occur within 12 months. In October 2004, interest rates rose dramatically, leading to a sharp decline in property market. It was estimated that fair value building, so the fair value building was 13 million, but Bath has not reduced the advertised sales price of the building. Even though building fair value went down, but what Bath did, he did not reduce the advertised sale price of that building. He kept it as it is, which it was before reducing the reduction of the fair value of the building. So now the correct treatment you have to tell. This is very easy. It's IFRS 5 according to this standard because you're selling it after having it. That also within 12 months. So this tells you whether which standard to apply. IFRS 5. Okay. Remember, you just cannot say that an asset is held for sale. You have to look out for the conditions. If it is satisfied, then yes, classify it as held for sale. How can you say when it is held for sale? If it is available for immediate sale, immediately you can sell it in whatever condition it is, and this sell has a very high probability of occurring. Okay, so from the case study you have to refer. Okay, so for it to be highly probable, there should be an active plan also. What is that active plan? That you are finding a buyer. Okay, as it is marketed at a price that is reasonable in relation to its fair value, should not be too high or too low. You're charging the price which is very reasonable to the fair value currently in the market. Okay, and this sale should be expected within 12 months, not more than that. But of course, there is an exception to this, okay, which is not here in this answer, I think. But exception is that if you have all the conditions in place, you have met, but even though you are not able to sell it within 12 months, maybe you're selling it in 13 months or 14 months, after 12 months, still it will be classified as held for sale. Why? Because some conditions occurred maybe that were not in your control, not in your hand. Because of that, you were not able to sell. But other than that, all the things were there in the place. You were finding for the buyer, you got the buyer, price was set up, everything was there. At the end, you were not able to sell it. So it was not sold within 12 months. But still, it will be classified as held for sale. Okay, that is an exception, but I think it's not there in this answer. Okay, anyway. So when something is classified as held for sale, what is the measurement? How do you measure it? Lower of its carrying amount and fair value less cost to sell. You see what is the lower out of the two, whether it's the carrying amount or whether it's the fair value less cost to sell. So on 30th September 2004, on this date, what is the probability of the sale? Now one by one you're linking the point to the case study, whether there's a high probability of sale or not on this date. There is. Why? Because the building was marketed at its fair value in the beginning on this date. Later it didn't reduce the price, but initially it was. Okay, what is the carrying amount? On 30th September 2004, 16 million. How? 20 million is the cost. Okay, and into 40 divided by 50. You have bought it for 20 million. Okay, for 50 years, the total is 50 years, right? Out of that, what is it? It became 40, right? It will be 40 over 50. Just, oh, wait, just to give 40 years. How is it 50? Let me check. Okay, because it's, I assume it's not 2000. Okay, 20 W4 means let's say it is 2004, and 20X4 means let's take it as 2014. That's how they have taken it. So 10 years went here. That's why they have reduced that 40 over 50. Okay, that's how they have calculated it. 20W4 means 2004, and 20X4 means is after 10 years, right? Yes, that's how they have taken it. But that's okay. Probably in the exam they will give you the correct the numbers, not in X and W. So it's 40 over 50 depreciation you have to deduct from this 20, 16 million. Okay, the 10 years depreciation you have to deduct from this 20, hence it will be 16 million, the carrying amount. Okay, find the fair value less cost to less cost to sell and see which one out of this is lower. So this is lower than the fair value less cost to sell. So carrying amount is lower. That means carrying amount you have to take. Why? Because fair value less cost. So what is the fair value? It is 17. Cost to sell is 0.1. Again, we'll see whether it's correct or not. We'll see in the case study. Fair value is 17. Cost to sell 0.1. Correct. 15 minus 0.1 will be something less than 16 only. But your carrying amount is 16. So it's correct. Carrying amount is less. Okay. Which is 16.9. Carrying amount is 16. This is less. So the asset should be continued to be held at 16 only. Correct. Now we are talking about the interest rate. Rise in interest rate. This have occurred after the end of the reporting period. Okay. So therefore, any decline in the asset's fair value does not represent condition that existed at the reporting date. It happened after. Okay. So what happens? This is a non-adjusting event. Anything after the reporting date is a non-adjusting event. Because there is no condition at the reporting date that says that later after the reporting date uh, this will be the impact or the value of the asset will fall down. No, because this rise in interest rate, if it happened at the reporting date, then you can say in the future it will increase. The fair value fell down because of that. But this happened after the reporting period. Just see when the interest rate increased. The date is very important because of this reason. Whether it's in the reporting period or after the reporting. If it's after the reporting period, you have to decide non-adjusting, adjusting like that. So interest in October 2004 interest rate rose, but a sale took place on 30th September 2004. You see, this is why if fair value falls also because if interest rate increases, it will not be taken into account. Okay, it will be non-adjusting event, non-adjusting because after the reporting period, interest rate increase. So fair value even though it falls now at the reporting date, it will be non-adjusting event only because you cannot say now that in because of the rise in interest rate only assets fair value fell down. Okay, because that rise in interest rate happened later and assets fair value fell down before that at the reporting date. It's happening at two different dates. That's why it's a non-adjusting event. So this asset will remain classified as held for sale only for the period ended 30th September 2004. So the decline in the assets value, okay, why the assets value declined, this you have to describe in the disclosure note. Okay, now we are coming to D, the last for 7 marks. Okay, this is very important. You need to go a bit slow because it's IFRS 9. Okay, you cannot rush through. Okay, so during the reporting period, Bath purchased an investment in the shares of Bristol for 16 million. Investment in the share, very important to understand. It is investment in what? Because if it's a debt, things are different. Equity, things are different. For 16 million. and made a designation to measure them at fair value through other comprehensive income. It's an investment in equity. You have to understand this. Path received dividends of 3 million. At the reporting date, the quoted price of the share was 20 million, and present value of the estimated dividend that Path will receive over the next 5 years was 18 million. Next 5 years. Income tax was 25%. Tax base of the investment in shares based on historical cost. Since there are no plans to sell the shares, they believe that it would be misleading to account for any related deferred tax asset. There could be deferred tax asset also relating to shares. Now, Bath requests advice about the accounting treatment of investment in share. This is a tricky question. It's not easy to understand it right on the face of it. If you see there are many standards in this. IFRS 9, okay, I can see IFRS 9, IFRS 13, and your IAS 12 income tax. Definitely income tax they are mentioned. So one by one we are going to tackle this. First let us talk about IFRS 9. Forget about everything else because it's the first para is IFRS 9, very small only. Okay. So in accordance with this one, why we are talking about fair value? You will understand it. First let us read IFRS 9. Because this financial assets, first of all, identify what type of financial asset it is. Whenever you are dealing under IFRS 9, my dear friends, always understand whether the financial asset is at fair value, investment in debt or equity, and it is measured using what? Amortized cost, fair value through other comprehensive income, or fair value through profit and loss. These three things are very important. After that, your answer you can form. Okay. After that is just a ruling. So this is measured at fair value through other comprehensive income. Clearly, they have told that they have designated it in such way, the investment in share. So anything, okay, the remeasurement of fair value, the gain and losses will be recognized in other comprehensive income in your OCI only. So because fair value will go on the other comprehensive income, that means that fair value, how are you going to measure that fair value? Using IFRS 13. So this is why you need to understand the first thing very properly. Because it is measured fair value through other comprehensive income. Even though it is fair value through profit and loss, in both conditions, you need fair value. So this fair value, you are going to take help from IFRS 13. Understood? That's why the next topic is IFRS 13, fair value measurement. From here, you have to talk about all the three levels that you are going to use to measure the fair value. In this condition, which one is the best? Level 1, level 2, level 3. Okay. First, define what is fair value. I am not going to repeat the definition. Okay. Every time is the same exact words. Definition is the price that you will get for selling your asset today if you sell. Let's say your phone you are having the iPhone 10. Now you want to sell it today. Just go to the market and see what is the price. That price is known as the fair value. Okay. But if your product is very unique, okay, if there is no active market, no one is buying that product in a large quantity, the frequency is less, then it's very hard to get a fair value for those type of product. That's why you have there are three different levels: level 1, level 2, level 3. Level 1 is the easier, the most safest, and level 3 is the most risk is there in level 3 and most hardest also. But if level 1 and 2 is not there, then we have to go use level 3. Okay. But priority is always given to level 1 when you're measuring fair value. Okay. Level 1 means identical assets in active market. Let's say your car market is active market, right? It's very easy to find a similar car to the model, the brand that you are having, the same car. So in that case, it's very easy to get the fair value from the market. But in this case study, what management is doing, they're estimating the dividend based on some share price for 5 years, right? Using some present value. So management's estimate of the dividend that they are going to receive from this share is level 3 input. It's not level 1. Do you have an active market for that? No. Not active 2 also, because it's not similar also. Level 1, same asset, identical. It's like identical twins with the same phase and everything. Level 2 is not identical, but it's twins, you can say. They are similar. Level 3 is they are not twins at all. They're two different siblings, you can say. So in the same way, we are using something, right? Some method to estimate, which is risky again. So in this case also you are estimating the dividend which is level 3 input in the fair value hierarchy. It comes lower. Okay, so this should not be used to determine fair value because at level 1, because a level 1 input exists. Okay, this you should not use to determine the fair value. Why? Because in level 1 there is a quoted price that exists for an identical asset. Okay, if there is a quoted price for your share, you can use level 1. You don't have to use level 3. When you have the information for level 1, then you don't have to use level 3. Then you avoid. If you don't have any information, level 3 should be your last resort when you don't have any information about level 1 or 2. But if you have level 1, then you cannot say you have an option to go for level 3. No. Okay, how do you know? Quoted price. See, somewhere they have told that. Just let's go and see. See, they told at the reporting date, the quoted price of the share was 20 million. Quoted price. What does it mean? Level 1 information is there. The input for level 1 is there. The quoted price is there. Quoted means what? Level 1. So you have to use level 1 or level 3. Now we are talking about some calculation has to be talked. Okay, those are knowledge part. So this share has to be revalued to 20 million and a gain of 4 million will be recognized in OCI because we told fair value through OCI. Okay, so the gain in OCI, this should be classified as an item that will not be reclassified to profit and loss in the future period. Remember, when something goes into OCI, there are two types. One, that will be reclassified to profit and loss in the future when you're selling that share. Second, something that will not be reclassified to profit and loss. Okay. So, but what about the dividend that you have received? This 3 million will be recognized in profit and loss only. That will not go in OCI. Only the gain and loss for the shares will go to OCI. Let's see how 20 million. See, dividend is 3. Okay. See, 20 is the quoted price. Okay. And what is the cost? 16. But the quoted price is 20. That means from 16, it has increased to 20. So gain is 4 million only. Right? Understanding? So that's why 20 minus 6. It will not be reclassified. Okay. Just give me a minute to see why it will not be reclassified. Because usually they are reclassified. Okay. Investment in shares. The investment in shares, if any gain comes in other comprehensive income, according to IFRS 9, it will not be reclassified to profit and loss. Yes, I remember now. It will never be reclassified. Anything to do with investment in share, gain goes in other comprehensive income will never be reclassified to profit and loss. But if it's for investment in debt instruments, yes, then it will go. Okay, understanding? Now, now don't ask me why not and why not. Okay, the logic and all I cannot give you, but just try to learn it that way. Now we have last part, which is regarding the tax treatment, deferred tax, because investment in shares based on historical cost and 25%. Okay, tax base. This according to IS 12 we have to deal. So deferred tax. So this deferred tax is calculated on the difference between the carrying amount and the revalued asset. Within the carrying amount of a revalued asset and its tax base. See, tax base does not take revalued amount, it takes historical cost. Only your carrying amount, you will increase it, okay, if revaluation happens. Remember that. That's why there's a difference. On that difference, you have to find the tax, even if there is no intention to dispose of the asset. What is the temporary difference? 4 million. Why? 20 million is the revalued amount, 16 million is the cost. Cost is taken by the tax base because they told tax authority they will calculate on the historical cost, which is 16. But you are taking the carrying amount, that is 20 million, the revalued amount. So 20 minus 6, difference is 4. On this 4, you are taking the deferred tax. What is it? 25% on this 4 million, which is 1 million only. which will give rise to deferred tax liability. Remember, you have to always mention whether it's a deferred tax asset or a liability, and where will it go also, that also you have to mention. So deferred tax liability, why? Your carrying amount is 20, your tax base is 16, carrying amount is more than tax base. It's a positive figure. That's why it's a deferred tax liability. Understood? So any gain on this investment that was recognized in OCI, okay, that's why even the deferred tax charge will be recognized in OCI. It will not go to profit and loss because the gain for that investment was recognized in OCI, fair value through OCI, right? For this investment in share, that's why deferred tax charge also will go to OCI. All these rules are there, okay, in your deferred tax IS 12. If you can visit, or you can go to IFRS 9 is there. Okay, this explanation is there in broad detail. So that's it, and I hope that this is a very good question. In fact, I mean, all the standards are covered here: IFRS 9, IFRS 5, IS 12, and whatnot. So see you in the last test to understanding, that is test to understanding 8. I think that will cover your integrated reporting and other issues. Okay, so let's see you in the next video.